Hello, my name is Eric Never, Vice President of Thomson Reuters DT Tax and Accounting. Welcome to the ninth edition of Synergy Canada. This is the third year that we're using a virtual format. We had a record number of participants last year, and I'd like to thank all of you who took the time to complete the survey and provide your feedback last year. Many of you praised the rich content. Well, I'm happy to announce that this edition of Synergy will break all our records in terms of content available throughout the day. Once again this year, we have a packed program with everything you need to get a head start on the upcoming tax season. Whether this is your first conference or you're a regular, I congratulate you on making this investment in your practice and, most importantly, thank you for your trust in our team. We've worked hard and you won't be disappointed. My presentation is organized into four main themes: Onvio Tax, the DT Professional Suite, the Learning Center, and what to know and do to get ready for tax season. To begin, I'm going to share with you some of the highlights for Onvio Tax in the past year. As a reminder, Onvio Tax is our next generation cloud software that we've been working on for a few years now, and it's getting better every season. In last year's edition, we talked a lot about the e-signature in DT Max using Onvio for management to communicate with the client. The e-signature is now available in Onvio Tax, which allows an easy and user-friendly integration with Onvio for management. We can see on the screen that Julia Carter's return is ready for refile. We will then click on the e-signature tab. This will prepare the request for the client to electronically sign the T183. The transmission can be done once the client has signed the form. After the request is sent to the client, it will remain active for a period of 7 days. It's also possible to revoke a request if necessary. Here you can see the federal processing status for all family members. The status will automatically update once your client has signed the T183 form. You can see here that the status for the family head now shows signed. Information on the date and time the authorization form was signed by the client can also be accessed. It's now quick and easy to get an overview of a client's information by accessing the client dashboard. For example, the client's phone number, the name of the staff member assigned to the file, and the names of the family unit contacts. It's also possible to have a complete picture of the e-file situation for the client and their family members, whether it's the transmission status, the refund, or the download of the notice of assessment. A year ago at Synergy, I invited you to be part of our early adopter program. The February launch and June conclusion of the early adopter program were two critical milestones for our team. We learned a lot from the group of 15 firms that generously participated in the pilot program. Our goal was to reach a milestone of 500 electronically filed returns using Onvio Tax. Goal achieved, and we even add a few T1135 foreign income filings. But the most important thing for us with the early adopter program was to get the feedback from participants to validate some of our assumptions and to learn things we had not heard previously during user research and client interviews. So here are some of the key findings from the program. What participants like, the reliability of the results, intuitive data entry, including side-by-side display, quick and easy uploading of data with autofill my return from CRA and tax data download from Revenue Quebec. On the other end, things that need to be improved or fixed, the speed of loading and changing tabs, missing the ability to custom sort the PDF pages to your liking, the need to manually create unique customer IDs in Onvio Center, and finally, having to enter information more than once in some cases. It's important to note that there was a good mix of users, with the volume of returns submitted ranging from low to high. Among the other comments, here are a few that caught our attention. Adding an option to transmit the entire family in one click rather than one at a time, making available the invoice as well as the comparison summary with the previous year, and having a single point of contact per family unit for sharing documents. Preparations are well underway for the next tax season. We will have new tools in place to interact with users directly in the program for better feedback. After the great success of the pilot program, I'm pleased to announce that the early adopter program will be back. As a Synergy participant, you have priority, and I encourage you to visit the Onvio booth to learn more about how to join the program for the next tax season. While we work hard to improve on Tax, we continue to invest in DTMax and listen to your suggestions. That's why in the December version, it will be possible to display in the client list the amount charged to your client for preparation and filing of their returns. Here's how to do it. First, choose billing from the preferences menu. Then, check the box include the invoice total to list Memo 4 keyword. Still from the client list, click on the icon for settings, the one with the wheel, and check the option Keyword Memo List 4. Once these steps are complete, all you have to do is use the bill keyword group to produce your client's invoice. Once the calculation of the return is done, the amount will automatically be added to the Memo List 4 keyword and to the client list. Shifting gears now to T2. As of the June release, the CRA T2 autofill service allows you to receive the CRA notice of assessment for your client directly into DTMax. And that as long as you are an authorized representative for the corporation in question. To do so, you need a rep ID with the Represent the Client portal and a valid RC59 for online access on file. Changes have been made so that when the keyword inactive file is used in a client's data, the option chosen for this keyword is displayed in the client list in the processing status column, as we can see on the screen with final year process. In September, a T2 update was made available to incorporate changes relating to the immediate expensing incentive. Federally, Schedule 8 has been updated to reflect these changes first announced in the 2021 federal budget. If an eligible person or partnership is a Canadian controlled private corporation, a property may qualify as a designated immediate expensing property if, among other conditions, it's acquired after April 18, 2021. For Schedule 1381 in Alberta, only the calculations have been incorporated as the updated schedule was not available. In Quebec, the calculations for immediate expensing have also been incorporated into Form CO 130.A with the inclusion of the two new Quebec forms CO 130.AD and TP 130.EN. In addition, although the in-house rental schedule has not been updated, the calculations have been included in this version. I strongly encourage you to consult the What's New for version 2535 for all the details. Version 2520 marked the launch of eFile for Trust. As a result, it's now possible to file a T3 return and a T3M return when the tax year ends in 2022 or after. Form T183 Trust information return for electronically filing of a declaration of trust must be completed and signed by the trustee, executor, liquidator, or administrator before the return is filed for the trust. Refer to the Notes and Diagnostics section of DTMax to correct any errors that prevent e-file. You will then be able to proceed with the electronic filing of the T3 return or T3M return via the e-file icon in the client list. Our team continues to work on adding new forms. The T1135 should be supported by the T3 e-file in the first quarter of 2023. Since last season, the electronic signature of the T183 authorization form is integrated with DTMax for Onvio for management users, allowing you to have your client sign the form in the Onvio Client Center. The integration with DTMax is seamless as, for example, an entry is automatically added to the client's audit trail to record it when an e-signature request is sent to your client through Onvio. If you have suggestions for new forms for which you would like DTMax to automatically add a space for e-signature, please visit the Onvio booth or enter the name of the forms in the comments of your Synergy survey. In September, we officially launched the Learning Center, a modern and professional portal to access our DTMax training offerings and implementation of our firm management solutions. The portal is ideal for accessing a variety of training for you and your employees. In addition, it's an excellent way to facilitate the training and integration of new employees. The Learning Center is a cloud-based portal that can be accessed at any time with a 12-month subscription. There are currently two DTMax packages, the foundational implementation and the guided implementation, including access to webinars and courses. It's also possible to add personalized sessions according to your needs. That's not all. You can also purchase implementation and consulting packages for Onvio Firm Management and DT Practice solutions. We're also working on adding a T2 basic course for those of you who would like to prepare corporate returns but do not have the basic knowledge required. Our brand new solution, Practice Forward CA, will also be available through the portal soon. I invite you to take the time to watch the short Learning Center video in the bonus content section of Synergy for a demonstration of how the Learning Center platform works. Since last year, we offer a premium advisory solution. Practice Forward Canada is a coaching program designed for Canadian forward thinking firms who want to learn how to build advisory services in their practice, become a trusty advisor relationship, establish standardized pricing and prepare upfront billing, give your business a clear direction, be confident in the value you bring and not give away your valuable knowledge. The famous, may I ask you one quick question? On top of that, the Practice Forward program provides access to helpful templates and tools designed specifically for Canadian firms. All of that is done through a phased approach with one-on-one sessions with our expert consultant. To learn more about advisory services, take the time to attend the workshop How to Write a Business Proposal That Wins You More Clients with David Caron this afternoon. But that's not it. As a Synergy participant, you qualify for our Evolve Your Practice contest. All you have to do is visit our Firm Management Solutions booth and give your name. You can also contact your sales rep by the end of the week to let them know you're interested in joining the contest. You may win a free participation to the Evolve Your Practice 3-episode advisory event on December 13th. This virtual event consists of 3 blocks of 90 minutes, determining your value, delivering a value proposition, and behind the scenes, advisors in practice, how they made it theirs. This one-day event has a $449 value and is a great introduction to the shift to advisory services. Good luck. Now, here's a melting pot of useful information in preparation for the tax season. Let's start with some noteworthy federal measures. Immediate expensing of capital assets, enhanced tax credits for home buyers and home accessibility tax credits, increase in the deduction limits for vehicles, revision of the North American Industry Classification System, and for measures specific to Quebec only, improvement of certain components of the tax credit for home support for seniors, requirement to enter the trust identification number as of January 2023 on all returns filed with Revenu Quebec. Last but not least, Ontario is enhancing its low-income individuals and families tax credit, also known as the LIFT credit. Now is the time to renew your e-file account if you haven't done so already, in order to avoid bad surprises and also unnecessary stress. Please be advised that a rep ID is now required for all e-file registrations or renewals. If you already have a rep ID, you must provide it when you renew your account. If you do not have a rep ID, you can obtain one by registering with Represent a Client. Revenu Quebec would like to remind you not to mail the form CO 1012 for a lost carryback if the form was completed and electronically filed with the corporate tax return. Now more than ever, it's important to back up your DTMax database regularly. The easiest and most reliable method is to use the DTMax built-in backup utility available through the backup option in the Tools menu. Note, though, that a backup copy of your computer or equivalent is also required for archive, scan, and attach documents such as notes. Our mailing list is the best way to keep you informed of the latest news regarding your Thomson Reuters DT Tax and Accounting products and services. If you're not already a subscriber, you can do so by visiting the link on the screen. Just enter your email address and you're done. On that note, allow me to remind you that Thomson Reuters offers MFA free of charge. If you haven't set it up yet, you can use your smartphone as an additional authentication factor in 4 easy steps. Contact support to obtain a base level Onvio firm, add staff to Onvio, enable MFA in Onvio, enable MFA in DTMax via the Preferences menu. That's the best way to protect your firm and your clients' data. By the way, you can get more details on MFA by visiting our Onvio virtual booth at any time today. Thank you for your attention. I hope you found this presentation informative and interesting. Let's now take a quick look at what's coming up. The tax update with Jerry Vitoratos follows shortly. The CRA and Revenue Quebec will take turns informing us about upcoming changes. We will then have a demonstration of Onvio Tax by Scott Drummond, followed by a recap of the early adopter program for the 2021 tax season with our UX and UI expert, Carl Bujikanyan. In the afternoon, you have plenty to choose from. At 2:30, it will be either the eFile workshop with Emmy Valme or the DT Max productivity features with Jerry Vitoratos at the helm. Starting at 3:30, you can choose the How to Write a Business Proposal workshop that wins you more clients with David Caron, or the Improve Your Interactions with Your Clients workshop with our prolific Emmy Valme in charge. That's not all. You also have access to bonus content that you can access during the day or in the coming weeks. In fact, as a Synergy attendee, you'll have access to all the presentations up to and including March. I look forward to seeing you at 4:30 p.m. for the closing remarks and the participation prizes draw. Once again, thank you for being with us today. Enjoy your conference.
Thank you, Eric, for the official launch of Synergy 2022. Ladies and gentlemen, good morning and welcome. My name is Jérôme, and I will be helping you navigate throughout the day. I would like to start off by saying thank you to Eric and his team for making this event possible. Again, this year, for security reasons, our conference will be held virtually. However, rest assured that we are all looking forward to see you again in person in a future edition of Synergy as soon as developments relating to COVID-19 allow us to consider a return to normal. In the meanwhile, Eric and his team are committed to delivering the best content as well as the latest news and updates from the tax and accounting industry. Some housekeeping items for today. To navigate between the general sessions, workshops, and virtual booth, you may use the links located at the top of your screen or simply click on the Return to Main Page button and select the desired option. Should you encounter any issues, you may reach out to our help desk team who will be able to assist you. We will not have any Q&A sessions after the presentations. However, you may visit the virtual booth area where you will have a chance to interact with our presenters. I would like to remind you that today's presentations will be sent to you via email. Finally, we ask you to kindly complete the survey and provide us with your feedback so that we may tailor our content for next year's conference. Now, it is my pleasure to introduce our first presenter, Jerry Vitoratos. Jerry has been working with Thomson Reuters for over 10 years as a trainer and tax support resource person. He has been providing training sessions to tax professionals all over Canada. He has also made several radio and TV appearances on BNN and Global TV as the UFile tax specialist. Jerry obtained both his graduate diploma in taxation in 2018 and his master's degree in taxation in 2020 from the Université de Sherbrooke. I would like to invite Jerry to present to us the 2022 tax update. Jerry, the floor is all yours.
Hello, and welcome to the tax update session of Synergy 2022. My name is Jerry Vitoratos, head trainer for DT Tax and Accounting, a division of Thomson Reuters, and I will be presenting to you the tax changes that are coming up for the next tax season. So the agenda for this session is going to be, first, we're going to look at the personal tax measures. So what is about to change as far as the personal tax return. Then we're going to look at corporate tax measures. And then, differently from other years where we've given this session, we're going to look at two new categories. One is personal and corporate tax measures, meaning that these are tax changes that will affect both returns in this case, so the T1 and the T2. And then finally, we're going to look at other measures that are tax related, but not necessarily related to the tax return itself. Let's start with the personal tax measures. And the first thing we're going to start with is a brand new tax-sheltered account created by the federal government called the Tax-Free First Home Savings Account, or FHSA for short. So this new account is, as I mentioned, a tax sheltered account, and the purpose of it is to save money for the purchase of a first home. Contributions to an FHSA are deductible, and income earned within the FHSA are not subject to tax, hence why I mentioned it's tax sheltered. Qualifying withdrawals from an FHSA made to purchase the first home would be non-taxable. So as long as the withdrawal is made to purchase for what the government considers as a first home, it is non-taxable. And finally, eligible individuals will be able to create these accounts starting in calendar year 2023. Now, who is eligible for this new tax sheltered account? Number one, it must be an individual that is a resident of Canada. Secondly, they must be at least 18 years of age in order to create the account. And thirdly, and most importantly, they have to be a first-time home buyer, which essentially is the same rule as what we see currently with the home buyer's plan, meaning that this is an individual that does not own a home currently that they're living in and has not owned a home in which they lived in the last 4 years. Now, how do the contributions work? Well, first and foremost, there's a lifetime limit on contributions of $40,000 and an annual contribution limit of $8,000. Now, individuals will be able to claim a tax deduction just like an RRSP contribution. So it works the same way as an RRSP contribution. However, the individuals cannot deduct any contributions made in the first 60 days of the following year, unlike an RRSP contribution. And finally, if individuals have not used up the entire annual contribution limit in the year, they can carry forward the excess amount to the following year. Now, an individual can hold more than one FHSA account, but the total amount that they contribute to those FHSA accounts is the annual limit and the lifetime limit. So they're bound by the two limits that we mentioned before. Okay, now an individual is also not required to claim a deduction if they don't need it, just like an RRSP contribution. They can carry forward that deduction to future years. So what kind of investments can you purchase within an FHSA account? Well, they're the same kind of investments that you can purchase for a TFSA account, meaning they can be mutual funds, they can be publicly traded securities, bonds, or GICs. Now we get to qualifying withdrawals. As I mentioned earlier, the purpose of an FHSA account is to have a tax-sheltered account in which you save money in order to withdraw for the down payment of the purchase of your first home. So when can we make this qualifying withdrawal? Okay, well, first things first, at the time the withdrawal is made, the taxpayer has to be a first-time home buyer, as I mentioned before. Again, the rules are very similar to the rules that we have for the home buyer's plan. Second of all, the taxpayer must have a written agreement to buy or build a qualifying home before October 1st of the year following the year of withdrawal, and they must intend to occupy that qualifying home as well. In other words, that home is to be their principal residence. Now, the housing unit must be within Canada. It cannot be a house that is purchased outside of Canada. And the entire amount of the FHSA account can be withdrawn at the time of purchase, or you can do a series of withdrawals when you purchase the first home. Once the withdrawal is deemed a qualifying withdrawal, it means that the amount will be tax-free for the individual who is making the withdrawal. Therefore, no income amount is included on the tax return when a qualifying withdrawal has been made. Now, what happens in the case of a non-qualifying withdrawal, meaning you've withdrawn from the FHSA account for a reason other than the purchase of a first home? Well, in that case, the amount becomes taxable on your tax return or on the individual's tax return. Now, the financial institution has to collect a withholding tax for that non-qualifying withdrawal as well. Transfers can be done between an FHSA account and an RRSP account on a tax-free basis. On top of it, these transfers are not bound by the RRSP contribution limit of the taxpayer. However, these transfers would not reinstate the individual's FHSA lifetime contribution limit. Now, transfers can also be done the other way, from an RRSP account to an FHSA account on a tax-free basis as well. However, these transfers would be bound, in this case, by the annual and lifetime FHSA contribution limits of the taxpayer. Okay, although such transfers would be subject to the FHSA contribution limits, they would not be deductible and would not, unfortunately, reinstate the individual's RSP contribution rule. Continuing with transfers, an FHSA would cease to be an FHSA account at the earliest of the next two events, either when the account reaches 15 years old and there's been no purchase of a qualifying home, or when the individual turns 71 years of age. Any unused savings can be transferred directly to an RSP or a RIF. Otherwise, they become a non-qualifying withdrawal and they become taxable income on the taxpayer's return. So how does this plan interact with the home buyer's plan? Because we do see some shared rules between these two plans. For example, the definition of a first-time home buyer is the same essentially between the home buyer's plan and the FHSA plan. Can a taxpayer use both in the year that they make a purchase of a first home? Well, the answer is no. The taxpayer will have to make a choice between a withdrawal from an FHSA plan or a withdrawal under the home buyer's plan. Okay, they cannot do both. In the case of spousal contributions, well, unfortunately, there are no spousal contributions, unlike an RSP, where one spouse can contribute into the RSP account of the other and claim the deduction on their return. However, there are also no attribution rules when it comes to the FHSA accounts, meaning that one spouse can give the funds to make a contribution into the other spouse's account, and there are no attribution rules that come back to them. What happens in the case of a deceased individual? So, for example, you have an FHSA account holder that dies during the year. Well, if the beneficiary is the spouse, then the surviving spouse becomes the new holder of this account immediately upon death and continues to use the FHSA account. Okay, inheriting the account does not impact the surviving spouse's contribution limits. So the transfer happens on a tax-free basis. If the surviving spouse is not eligible to create an FHSA account, meaning that at the time of death, they don't meet the three criteria that we mentioned before, then in that case, they can transfer the account or the funds of the account to an RSP or a RIF account, again, on a tax-free basis. Now, if the beneficiary is not the spouse of the FHSA account holder, then it becomes a withdrawal, and the withdrawal is taxable in the beneficiary's return. So next change that we have is the home buyer's amount credit. This is an existing credit that's been around for a few years. This non-refundable tax credit has been doubled now from $5,000 to $10,000 as of the 2022 tax year. Next, we have the multi-generational home renovation tax credit. This is a new refundable credit in which you can claim expenses to renovate a home to create a secondary dwelling for an eligible relative, in order to house an eligible relative through this secondary dwelling. So this is a refundable credit at a 15% clip, and the expenses are capped to $50,000. This credit will be applicable as of the 2023 tax year. Now, what are some of the particulars of this credit? First of all, the qualifying individuals are seniors who are 65 years of age or older, or any adult who is entitled to the disability tax credit. So who are the eligible individuals that can claim this new credit as of the 2023 tax year? Essentially, it is the qualifying individuals that we mentioned before, the two types, and also what the government calls a qualifying relation. By qualifying relation, the government describes as a parent, grandparent, child, grandchild, brother, sister, aunt, uncle, niece, or nephew of the qualifying individual that we saw before. An eligible dwelling for the purposes of this credit is a housing unit that is owned by either the qualifying individual or the qualifying relation. And of course, it must be ordinarily inhabited by those individuals as well. Now, as far as qualifying renovation, it has to be of an enduring nature, an integral part of the eligible dwelling. The key point here is that it has to be used for the creation of what the government considers a secondary unit. And what the government describes as a secondary unit is a self-contained dwelling unit with a private entrance, kitchen, bathroom facilities, and a sleeping area. Qualifying expenditures includes the cost of labor and professional services, building materials, fixtures, equipment, rentals, and permits. It does not include recurring expenses or repair or maintenance, for example. Next, we have the change to home accessibility tax credit. The change is what? Very simply put, the government is increasing the annual expense limit, or doubling it in this case, from $10,000 to $20,000 of eligible expenses, and this will be applicable as of the 2022 tax year. Residential property flipping rule, a new rule enacted by the federal government for any residential properties that are sold on or after January 1st, 2023. What the rule is, very simply put, if you own a property for less than 12 months and then you sell the property for a profit, well, those profits will be deemed as business income instead of a capital gain. Now, there are some exceptions to this rule. So, for example, if the sale is as a result of a death, a household addition, a separation, a disability or illness, or an employment change, these are some of the examples where this residential property flipping rule would not apply. Now, if you are subject to this deeming rule, then the principal residence exemption is null and void. Essentially, you cannot claim the principal residence exemption if you are subject to this rule or the deeming rules as we just spoke about. Labor mobility deduction for tradespeople, a new deduction introduced for the 2022 tax year and on, which is a new deduction to recognize certain travel expenses incurred by specific tradespeople who work in the construction industry. So this measure would allow these workers to claim up to $4,000 in eligible expenses as a deduction on their tax return. So an eligible individual for this new deduction, very simply put, is a tradesperson or an apprentice who works in the construction industry and makes a temporary relocation in order to work. Now, an eligible temporary relocation is a relocation that is at least 150 kilometers closer to the new work location that these individuals would have to go. The particular work must be located in Canada as well, and the temporary relocation must be for a minimum duration of 36 hours. Eligible expenses for this deduction is temporary lodging to the new work location, transportation costs for the individual, in other words, the one round trip to the work location in this case, and thirdly, meals incurred during the traveling to the new work location. Now, if an individual has received any non-taxable financial assistance from their employer, then all these expenses that I just mentioned are non-deductible on their return. The maximum amount that can be claimed is capped at 50% of the employment income that was gained at the new work location. Now, expenses that have not been claimed can be carried forward to the following year. So these expenses can be carried forward for a total of 2 years. Medical expense tax credit for surrogacy and other expenses. What the government has done here is they've expanded the definition of what a patient is for the purposes of these specific expenses. So now a patient is defined as the taxpayer's spouse or common law partner, a surrogate mother, or a donor of sperm, ova, or embryos. So the result of this expansion is to allow the claimed medical expenses for certain expenditures incurred with respect to a surrogate mother or a donor of sperm, ova, or embryos. This will be applicable as of the 2022 tax year. Eligible expenses include any expenses paid to a fertility clinic, a donor bank, or any other amount paid to obtain sperm or ova to enable the conception of a child. In vitro fertilization procedures as well, with respect to surrogate mother, will also be eligible as well. So now let's have a look at the changes on the corporate tax return, more specifically corporate tax measures. We'll start with the small business deduction, and more specifically, the reduction of the small business deduction. We know that the small business deduction gets reduced progressively starting at a taxable capital of the corporation and its associated corporations of 10 million and above. And then the maximum reduction gets hit when we hit the 15 million taxable capital mark. Well, the government is expanding now that progressive reduction, and instead of it being between 10 and 15 million, now it'll be between 10 and 50 million, 50 in this case. Now we go to a new measure, and more specifically, a new designation that the federal government has created for specific private corporations. Not CCPCs in this case, but other private corporations. So the government has created a designation called the substantive CCPC. So a substantive CCPC is essentially a private corporation that is controlled by Canadian individuals, but that is not a CCPC. Now, the purpose of creating this new designation is essentially not allowing these other private corporations from avoiding refundable taxes on investment income. So normally private corporations that are non-CCPCs would not be subject to refundable taxes on their investment income. By creating the substantive CCPC, the government is trying to enact the same rules that CCPCs have to deal with on investment income for other private corporations as well. So a substantive CCPC, very simply put, according to the definition here, is a private corporation other than a CCPC that is controlled by Canadian resident individuals. That's simply put what the definition is. The moment the private corporation meets that definition, now there are specific tax consequences that, as you will see here, are very similar to the tax consequences of CCPCs when it comes to investment income. Number one, the substantive CCPCs will be subjected to the additional refundable tax, or ART, on their aggregate investment income. Number two, they won't be eligible for the general tax reduction of 13%. Number three, this aggregate investment income that they will gain will be added to their non-eligible refundable tax on hand, or NERDTOH. Fourth, any income that will be paid out to the shareholders will be part of the low rate income pool, and unfortunately would not be eligible as eligible dividends. They wouldn't be eligible to be paid out as eligible dividends. So we see the theme here. The government, this essentially is an anti-avoidance rule. The government is now subjecting these other private corporations to the same rules as CCPCs when it comes to their investment income. Other tax consequences that are related to substantive CCPCs, for those specifically, for example, that hold shares in a foreign affiliate, they will be subject to a relevant tax factor of 1.9 and so on. Now, the application of this rule starts for taxation years that end after the budget date, which would be after April 6, 2022, unless they fall under one of the exclusions that we see below. So essentially, you're talking about first year, et cetera, et cetera. So now let's have a look at corporate and personal tax measures. So more specifically, we're going to look at changes that affect both the corporate tax return and the personal tax return as well. So we'll start with the Small Business Air Quality Improvement Tax Credit. So this is a new refundable credit that was announced in the last fall economic statement, in which eligible entities, or businesses in this case, can claim expenses related to air quality improvements in what the government calls qualifying locations, essentially meaning their buildings. So the eligible expenses that can be claimed for this credit are incurred between September 1st, 2021 and December 31st, 2022. So as I mentioned before, the credit is a refundable credit, and the credit rate will be 25% up to a maximum of $10,000 of qualifying expenditures per qualifying location and a grand total of $50,000 across all qualifying locations. So who can claim this credit? Who are what the government calls the eligible entities? Well, the eligible entities are unincorporated sole proprietors or self-employed individuals in this case, or Canadian-controlled private corporations with a taxable capital that is less than $15 million in its previous taxation year. So what type of expenditures can be claimed in this case? Well, first, the purchase, installation, upgrade, or conversion of mechanical heating, ventilation, and air conditioning, or HVAC systems, as well as the purchase of devices designed to filter air using high-efficiency particulate air, or what we commonly know as HEPA filters. Now, as far as qualifying locations, what are these? These are properties used by the eligible entity, in other words, the CCPCs or the self-employed individual, primarily in the course of its commercial activities. So, for example, a self-employed individual that is using a portion of their home for their business cannot claim expenditures for that particular building or their home, in other words. So, as I mentioned earlier, the qualifying expenditures that can be claimed for this credit are expenditures that were incurred between September 1st, 2021 and December 31st, 2022. So we have essentially 2 calendar years in which we can claim these expenses. So when does the eligible entity claim these expenses on their tax return? Well, for any expenses that were incurred before January 1st, 2022, those expenses would be claimed in its first taxation year that ends on or after January 1st, 2022. For any expenditures that were incurred on or after January 1st, 2022, they would be claimed for the taxation year in which the expenditure was incurred. Very simply put, 2022. So the credit itself that is received by the eligible entities is considered government assistance by the federal government. Therefore, the credit must be added back for the tax year in which it was received. So now we're going to go in depth in one of the bigger tax changes that was announced by the federal government recently, and that's immediate expensing of depreciable property. So immediate expensing, very simply put, is where businesses or eligible businesses in this case can claim up to 1.5 million of depreciation expense amongst eligible properties, to be spread out, in other words, amongst eligible properties. So at 1.5 million, this gives the chance to these eligible businesses to essentially take 100% depreciation on certain properties that are eligible in this case. Now, the incentive is temporary. It is applicable for any eligible property that is available for use before January 1st, 2024 or January 1st, 2025 in the case of individuals and Canadian partnerships where all the members are individuals. So as we take this deep dive, let's have a look at some very important definitions that comprise immediate expensing. So first, we have to look at which properties are eligible. In this case, the government calls it immediate expensing property. So immediate expensing property is essentially any depreciable property that is categorized in a CCA class other than, and I put it in bold in the presentation, classes 1 to 6, 14.1, 17, 47, 49, and 51. So it's other than those properties. Everything else is eligible for immediate expensing. Now, the properties must be acquired after April 18th, 2021 for CCPCs. So that was the budget date essentially. And after December 31st, 2021 for individuals and for partnerships. Now, the eligible property can be either new and no person or partnership has ever claimed the CCA on it, or it can be a used property. However, this cannot be a property that was rolled over to the eligible entity in this case, or the eligible business in this case. Meaning that if this was a property that was acquired under, for example, a Section 85 rollover, then that property is not eligible for the immediate expensing deduction. Next, who can claim this immediate expensing on depreciable property? So who's the eligible person or property, or as an acronym, EPOP? So number one, it is a CCPC throughout the year. Number two, an individual who is resident of Canada throughout the year. And number three, a Canadian partnership where all the members throughout the period are either Canadian-controlled private corporations, individuals resident in Canada, or a combination of the two. So multi-tiered partnerships, so partnerships with other partners, partnerships as members are excluded from this definition, meaning they cannot claim immediate expensing. Designated immediate expensing property, or DIEP. So this is basically the administrative side where the government tells you how you can claim this immediate expensing. So a taxpayer must designate the property on a specific form, essentially. 3 conditions have to be met in order to designate and claim the incentive. In this case, 1, the property must qualify as an immediate expensing property of an eligible person or partnership. We just saw the definitions of those 2 terms before. A property can only qualify as a designated immediate expensing property in the year in which it becomes available for use. And number 3, the third condition is the property must be designated in prescribed form by the eligible person or partnership by the filing deadline in which the designation relates. So they have to complete the appropriate forms within either the T1 or the T2 or the T5013 information return in order to claim immediate expensing. So as I mentioned earlier, the limit, the immediate expense limit, or IEL in this case, is 1.5 million. So that's the total amount of immediate expensing that can be claimed as a depreciation expense amongst all the eligible property. So this 1.5 million is not reserved for just one class. It has to be allocated amongst all the eligible property that a business can have. However, the government, in this case, to limit the amount that can be claimed, especially with what it considers as businesses that are related to each other, they've introduced the concept of associated corporations for the purposes of the immediate expensing limit. And this concept of associated corporations is very similar to the associated corporations concept that we see for the purposes of the small business deduction limit. Now, the way the government applies this associated corporation concept, similarly to the SBD limit, is by deeming partnerships and individuals that are related to CCPCs as deemed corporations. So how do we deem a partnership and individual as a corporation? How do we do it on a technical level? So the government essentially does is they define a partnership as a corporation with a capital stock with a single class of shares and with a total of 100 issued and outstanding shares. So the percentage of the membership of each partner represents the number of shares of that particular partner. An individual, in this case, is deemed to be a corporation that is itself deemed to be controlled by the individual. So basically only one individual owns 100% of the shares of that quote-unquote deemed corporation. Okay, so now by deeming these partnerships and individuals as corporations, now we could apply the existing rules or existing association rules that we find in the SBD limit under, Income Tax Act Section 256. Okay, so the same rules that would apply, that would associate corporations for the SBD limit would associate now these eligible people or partnerships to the CCPCs. Okay, now each EPOP, again, these are the eligible entities that can claim immediate expensing, have to file a prescribed form where they indicate the portion of the immediate expensing limit that they're allocating amongst each other. And each one of these, so be it the individual, the partnership, or the corporation, each one of these that are associated to each other under these new rules have to file this form within their tax return. So other rules that pertain to the immediate expensing incentive, for individuals and partnership EPOPs, they cannot create a business loss using the immediate expensing incentive, but CCPCs can. So this rule only applies to individuals and to partnerships, but not to CCPCs. Now, if the taxation year is less than 51 weeks, then the $1.5 million limit has to be prorated to the number of days that are within the taxation year. So these EPOPs cannot claim the full 1.5 in a short year end. They must prorate that limit based on the number of days in a taxation year. Now, if after the immediate expensing limit has been allocated to all the properties, to all the eligible properties, and there's still some UCC left over in these properties, then the standard CCA rules apply. So again, for the excess amount in this case, and not for the amount that has been taken under the immediate expensing limit. The half-year rule of acquisition is also suspended when it comes to implementing the immediate expensing to a CCA class. So now we're going to look at other measures, or what I call other measures in this case. So these are measures that are not directly linked to the tax return. Some of them are, but these aren't measures that you see on the actual tax return, whether it's corporate or whether it is personal. And in some of these changes, we're going to see actually new forms that have to be submitted to the CRA directly. So first, let's start off with the doubling of the GST credit, which is part of the affordability plan that was announced by the federal government. So the federal government is going to be doubling the last two GST credit payments for eligible individuals at the end of 2022. What does that translate to? It translates to essentially single Canadians without children would be able to receive up to an extra $234, and couples with two children, for example, would receive an extra $467 this year. Seniors, on average, can see up to $225 extra by the end of the year. Next, we're going to look at the Canada Dental Benefit, again, part of the affordability plan that the government announced recently. So this would essentially be an upfront tax-free payment to cover dental expenses for children that are less than 12 years old and that are not covered under either a provincial insurance plan or a private insurance plan. So the target implementation date for this new benefit would be December 1st, 2022, but it will cover any expenses retroactively from October 1st, 2022. So due to this benefit, we have a new law that has been enacted, which is called the Dental Benefit Act. So what's the eligibility to the plan? So who can apply and how can we be eligible for this plan? First, there's going to be a new form that the CRA is going to create in order to apply for the benefit. That's number one. So you have to apply for this dental benefit. It won't be done automatically through a transmission of a tax return. You must have a dependent that is under the age of 12 years old on December 1st, 2022, and for each subsequent period, which is going to be 2 more periods that the dental benefit will be applicable. You have to be receiving the Canada Child Benefit for that dependent on the application date. Your adjusted net income, which is, and by adjusted net income, we mean the definition of net income based on the Canada Child Benefit rules, must be under $90,000 per year in order to claim this benefit. And there must have been dental work or dental services expenses for this dependent that is not covered under a private insurance or a provincial healthcare insurance. So the amount of the benefit can be up to $650 for each eligible child if the adjusted net income or family adjusted net income is under $70,000, up to $390 if the adjusted net income is between $70,000 and almost $80,000, and then it's up to $260 if the adjusted net income is between $80,000 and almost $90,000. So we see here a progressive reduction of the benefit based on the increase of an adjusted net income. The benefit periods for the Canada Dental Benefit are going to be the period beginning from October 1st and ending June 30th, 2023. And then the second period will be between July 1st, 2023 and June 30th, 2024. There is a limit to how many dental benefits can be claimed. It is limited to 2 dental benefits per child in this case. And a special rule here that I wanted to mention for part-year residents, when it comes to adjusted net income, and there's a part-year resident amongst the family, or let's say both parents are part-year residents, then the adjusted net income is computed on a worldwide income basis. So you have to include the income that these individuals gained before arriving into Canada. So continuing with the affordability plan, we've got now the Canada Housing Benefit. And the Canada Housing Benefit is a one-time payment or tax-free payment of $500 to provide help for renters who are lower income Canadians. It's the CRA that's going to administer this program as well. And the eligible individuals would have to apply to the CRA through a new prescribed form that will be coming very soon. And it will be an attestation-based application process. There's going to be a new law that's going to be enacted as well. It is the Rental Housing Benefit Act. Now, who is eligible in this case for the Canada Housing Benefit? This will be an individual that is at least 15 years old on the reference day. We're going to see in a bit what the reference day is. Must be a resident of Canada in 2022 for the purposes of the Income Tax Act. Their principal residence or the property that they're renting is in Canada and they reside at that property. They have filed a 2021 tax return no later than the 90th day after the reference day. Again, I'll just give you the reference day now. It's December 1st, 2022. Their adjusted net income is below $35,000 for families and below $20,000, for single individuals. They are paying at least 30% of their adjusted net income on shelter, and they've applied to the CRA, like I mentioned, under a new form that will be coming, which is attestation-based as well. As you see the conditions there, the attestation base is basically, do they pay at least 30% of their adjusted net income on shelter? They have to prove that through this new form, no later than the 90th day after the reference day, which again, as I mentioned, will be December 1st. So there is the reference day, means the later of December 1st, and the day on which the act comes into force. It's actually one or the other. Cohabitating spouse or common law partner, only one spouse can claim the benefit. So when they're applying, if it's a married couple or a common law couple, only one of the two can claim the benefit. And with part year residents, again, just a little side note is that, again, adjusted net income is based on worldwide income and not just the income that they gained while they were in Canada. So now we get to the underused housing tax. This was, again, an announcement by the federal government to target essentially non-residents who buy real estate properties in Canada and don't actually live in them. There's, as the government considers them vacant or underused. So this is not a tax that's being charged on the income tax return. There will be a separate form that the CRA is going to create in order to charge the tax. The tax will be an annual 1% tax on the value. We're going to see the details in a couple of slides as to how to compute this tax. The tax is applicable as of the 2022 tax year, and we have a new act as well, a new law that's being enacted, which is the Underused Housing Tax Act. So, as I mentioned, there will be a mandatory declaration. So there's going to be a new form that the CRA is going to create in order to charge this underused housing tax. Now, all non-residents who purchase property in Canada and are considered as underusing that property would be subject to filing this declaration, this new form that the CRA is going to create. The only exclusion to that rule is what the government considers as an excluded owner. We're going to see in about a slide or two what an excluded owner means. Now, this annual return has to be filed on or before April 30, 2023 for the 2022 tax year. And the due date for the tax payable would be, of course, the due date of when you have to file the annual declaration, which would be April 30th, 2023. Excluded owners for the purposes of the underused housing tax are essentially Canadian citizens or Canadian residents, a corporation incorporated in Canada that trades on the Canadian Stock Exchange, a registered charity, a cooperative, an Indigenous governing body, a municipality, federal government, provincial government, etc., etc. So these entities would not be subject to the underused housing tax and therefore are not required to file an annual declaration. There are exceptions to paying the underused housing tax, meaning that you could fall under one of these exceptions that I'm about to mention to you in this presentation. And even though you're not an excluded owner, you would not have to pay the underused housing tax. However, that exception must be declared on the annual return. So an individual who falls under an exception is not exempted from filing the annual return, unlike excluded owners who are completely exempted from actually filing an annual return. One such exemption, in this case, is the qualifying occupancy provision, okay, or what the government calls a qualifying occupancy test. What the test is, basically, that the property would need to be occupied in periods of at least 1 month that total at least 6 months of the year by any individual that the government considers a qualifying occupant, which we'll see in a minute what that means. So the moment that individual meets the criteria of qualifying occupancy, which is living in periods of 1 month for at least 6 months, then they fall under the exception. And at that point, they don't pay the underused housing tax. A qualifying occupant in respect of an owner, so basically a person other than the owner, would include an individual that deals at arm's length with the owner or the owner's spouse and who resides at the property for at least 1 month under a written agreement. An individual that does not deal at arm's length with the owner or the owner's spouse, however, has a written agreement and is paying a fair rent to live in that property for at least 1 month. Now, if the owner is an individual, it could be that the owner or the owner's non-resident, non-Canadian spouse resides at the property for work purposes, in this case, and an individual owner's Canadian spouse, Canadian child, or a Canadian parent who occupies for a period of at least 1 month the residence as part of the residential property. Some other exemptions of the underused housing tax. I'm just going to briefly go through them. I'm not going to go through every single one. One would be a specified Canadian corporation. So this would be, a corporation incorporated in Canada in which one or more foreign entities that does not wholly control the corporation. From there, you have property not suitable for year-round use. So for example, you can't access the property during the winter, for example, or for a good part of the year. Property uninhabitable due to disaster or hazardous conditions. Property that is under major renovations. Year of acquisition, so the year that the property is acquired, then that individual or the taxpayer would not be subject to underused housing tax. And so on, death of the owner, and so newly constructed property, so on and so forth. Now, from here, we get to the calculation of the actual tax, and the calculation goes as follows. You see the formula as per the not the Income Tax Act, but the new Underused Housing Tax Act. In this case, it would be 1% of the greater of the assessed value on the property taxes, or the property's most recent sale price, especially if the sale price was in the previous year. Now, when it comes to letter B, there is an option to elect to consider paying the tax on the fair market value of the property instead of the assessed value or the property's most recent sale price. And this is on the next slide. Here we go. So there is an election that can be submitted through a prescribed form. In this case, it must be done on or before April 30th of the following calendar year. And in that case, the owner of the property elects to pay the 1% on the fair market value instead of the greater of what we just saw before, which is the assessed value or the most recent sale price. Late filing penalties apply for any entity or entities that would be subject to the underused housing tax and have not filed the annual declaration. It is the greater of $5,000 if the owner is individual or $10,000 if the owner is not individual, and the amount that is a total of 5% of the tax applicable in respect of the owner's interest, or 3% of the tax applicable in respect of the owner's interest in the property for the calendar year and each calendar month that the declaration is past due. Now, other penalties that come about if the declaration has not been filed up until a certain point, which would be for a calendar year that is not filed by December 31st of the following year, then the government starts pulling back some of the exemptions that I mentioned earlier. And some of those exemptions would be exemption for qualified occupancy, exemptions for not suitable for year-round use, exemption for uninhabitable due to disaster hazardous conditions, and exemption for a property ongoing major renovations. So we first have the late filing penalty April 30th. where we saw the amounts. If we don't file by December 31st, then the government starts pulling back on some of the exemptions that ordinarily these entities would be entitled to. Next, we have the Select Luxury Items Tax, a new tax that is being imposed at the point of sale for any sale or importation of certain vehicles and aircraft that are priced above 100,000 and for certain vessels that are priced above 250,000. I'm going to focus more on vehicles in this presentation, but just be aware that this tax is being charged also for aircraft and for vessels as well, in other words, boats. So, as I mentioned before, it's at the point of sale that the tax is being charged, and the vendor is responsible for collecting the tax. At certain exceptions, though, it would be the purchaser that would be liable to pay the tax as well directly to the government. All right, it has been in effect since September 1st, 2022. And again, a new law has been enacted for this new tax, which is the Select Luxury Items Tax Act. Now, the subject vehicle, so the motor vehicle that would be subject to is basically any vehicle that is designed to carry individuals on highways and streets, has a seating capacity of not more than 10 individuals. The gross weight would be 3,156 kilos or less. It has a date of manufacture after 2018 and is designed to travel with 4 or more wheels in contact with the ground. So you see, essentially, it's any car, any vehicle, essentially, that is being sold that would be worth over $100,000. Then the luxury item tax would be charged at the point of sale. Now, some exclusions to this tax would be an ambulance, a hearse, a motor vehicle clearly marked for policing activities, any other emergency vehicle in this case, and so on and so forth. Now, to calculate the tax, it is the lesser of the taxable amount, which we'll see in a minute what that means. The taxable amount multiplied by 10%, or the amount that results from subtracting 100,000 from the taxable amount and then multiplying the difference by 20%. So we take the lesser of the two. That is the tax that will be charged. And again, it is usually the vendor that is responsible for collecting that tax. Now, the taxable amount is essentially the greater of the following two that you see here on the screen: the retail value of the subject vehicle at the time at which it is registered with the government of Canada or a province, the retail value of the subject vehicle at the time at which it is registered with a vendor, and when the vendor first uses the subject vehicle. Now, there are new forms with this new tax. You see them here on the screen. So registered vendors, so at the point of sale, the vendors that are responsible for collecting the tax have to submit the form that you see on your screen right now, which is Form B500, the Luxury Tax and Information Return. They have to be submitted, in this case, to the CRA. And persons who are not registered and are not required to be registered under the Act but still have to collect that tax, will collect it under the other form, which is the B501. Now, the reporting period is very similar to anybody who's a GST or sales tax registrant. So it has to be for every calendar quarter. All right. And the return must be filed by the end of the month that follows the end of the reporting period. And again, the reporting period is quarterly. Now, there is one exception to that quarterly reporting period. It is for 2022, since the tax coming into effect in September. For 2022, there's only one reporting period, and that's between September 1st, 2022 and December 31st, 2022. The filing payment deadline is January 31st, 2023, exceptionally for 2022. And you see here the table that shows you the quarterly reporting periods. So we hope you enjoyed the presentation. All the details of everything that I've presented today are found in the PowerPoint that you saw within this presentation, which will be available to you during the Synergy conference. Thank you for watching.
Thank you, Jerry, for this tax update. Ladies and gentlemen, we will now take a 15-minute break to allow you to stretch a little bit. Once again, please keep in mind that Jerry will be available in the virtual booth area to take your questions. Thank you. Welcome back, everyone. Our next presenter today is Mr. Stuart Fletcher, Senior Program Officer from the Digital Communications section of the Assessment, Benefit and Service Branch of the Canada Revenue Agency, who will tell us about some recent changes to the CRA digital services, as well as a look forward on the changes to come. Without further ado, here is Stuart and the CRA updates for 2022.
Hello, my name is Stuart Fletcher. I work in the Digital Communications section in the Assessment Benefits Services branch of the CRA. The following presentation will highlight some recent changes to the CRA's digital services as well as a look forward on what's to come. Please note that all future release dates mentioned in this presentation are tentative and subject to change. My Account New Look and Feel. The CRA launched a beta for the new version of My Account in October 2021 and incrementally added content that users could test and provide feedback on. We are actively working towards the conversion of the portals to an updated design, some improved functionality, and ultimately a better user experience. On September 13, 2022, the CRA ended the beta and launched the new look and feel of My Account. Next, we will refocus our efforts towards the conversion of My Business Account and Represent a Client portals. A beta for the My Business Account is planned for May 2023. The current schedule is targeting October 2024 to have all three portals converted to the new framework. Here is a mock-up of My Account's new look and feel. The streamlined and simplified experience allows you to view more information at a glance. The improved navigation and upgraded user-friendly design makes it faster to find the information you need and complete your tasks, but still includes all the security features to ensure your information is protected. Luxury tax. The Government of Canada, as part of Budget 2021, proposed to introduce a tax on select luxury goods. The luxury tax applies to certain vehicles and aircraft priced above $100,000 and certain vessels priced above $250,000. A new luxury tax program account, identified with the LT Program Account Identifier, was added to My Business Account in July 2022. Here's an example screenshot of the luxury tax program account page on My Business Account. Submit document updates. A new Submit Documents radio button was added in My Business Account called Payroll Notices, Statements, and Vouchers. This button will replace the previous button entitled Submit Supporting Documents for PDR4, TX14, PIER, PD1114, PD7A, and other payroll account notices. When users select this new button, they are brought to a new subpage with a list of selections specific to payroll account notices. Represent a Client Enhanced Security. Previously, representatives could register for Represent a Client by creating a CRA user ID and password, or by signing in using a partner. This process includes authenticating by entering an access code and a postal code or zip code. In October, the security requirements changed to include the following two-step process. Step 1, provide personal information, which includes a social insurance number, a date of birth, current postal code or zip code, and an amount from an income tax and benefits return. Step 2 would be entering the CRA security code that is sent to you. This process is aligned with what we currently request for My Account and My Business Account. If you are currently registered with Represent a Client but have not accessed the service since October 17, 2022, and you do not currently already have an enhanced security, you are required to upgrade your credentials by providing this additional information and entering the CRA security code. Legal representatives in My Business Account. Legal representatives are now able to access the services of their business client's My Business Account. Previously, they were only able to have offline access. To get online access to a business client's account, representatives must provide their Rep ID in addition to their business's BN, when submitting all the required legal documents to the CRA. Legal reps will also need to be registered with Represent a Client. A legal representative is an individual or organization appointed by legal document and would have similar access to that of a delegated authority. Progress Tracker, My Business Account. As you might be aware, the Progress Tracker service is available in My Business Account for charity accounts and Canadian Amateur Athletic Association to track the progress of charity registration applications, registered charity information returns. As of October 2022, My Business Account users can now also track the progress of formal disputes, objections, and taxpayer relief and penalties and interest. As of November 2022, My Business Account users will be able to track the progress of T2 initial assessments and T2 adjustment requests. Here is an example of the Progress Tracker screens as seen in My Account. If we look a little further into the future, additional planned services to be added to the Progress Tracker are Canada Child Benefit applications, T1 initial assessments, and T1 adjustment requests. These updates are planned for February 2023. My Business Account and Represent a Client Print and Save. A new Print and Save link was added to most pages in My Business Account and in Represent a Client to provide a visually obvious option to print or save pages within these portals. Confirm My Representative is a two-step verification process to make it easier for clients to confirm who has access to their personal and tax information. This helps them play an active role in protecting their information. In October 2021, the process started for all new authorization requests received through Represent a Client for access to individuals and business accounts. Individuals need to go into My Account or My Business Account to confirm or deny an authorization request. In October 2022, business owners will now need to go into My Business Account to confirm or deny authorization requests received from eFile software. Here is an example screenshot of what an individual would see in their My Account or My Business Account if they had received a Confirm Pending Authorization notification. In February 2023, taxpayers or their legal representatives will be able to apply for the Disability Tax Credit online by submitting Part A of Form T2201 Disability Tax Credit Certificate. The second phase of this change will allow the taxpayer's medical practitioner to complete Part B of this form online and submit it to the CRA. The timeline for Phase 2 is still to be determined. Also part of its 2021 budget, the Government of Canada implemented, effective as of January 1, 2022, a national annual 1% tax on the value of non-resident, non-Canadian owned residential real estate that is considered to be vacant or underused. In My Business Account, a new Underused Housing Tax Program account will be added, and it is expected on February 2023. In My Account, Underused Housing Tax will be added as an option under the More Services section in My Account. In February 2023, a new Unallocated Payments section is expected to be available on the Accounts and Payments page in My Account. A Transfer a Credit button will be available to transfer unallocated payments to a tax and balance owing or to a current year installment. This update is expected to reduce the need for taxpayers to call the CRA. Here is a screen mock-up of Unallocated Payments section and Transfer a Credit button. In May 2023, we will be introducing optional email notifications for businesses. While some email notifications will be mandatory to ensure the security of accounts, such as when an address or direct deposit information is changed, Businesses will be able to choose to receive additional optional notifications such as a payment notification. Optional notifications in May 2023 will include GST HST reminder to file, payment notifications, GST HST compliance hold refund, and progress tracker for T2. More optional notifications will be added moving forward. Optional email notifications were already added for individuals in February 2022. First Home Savings Account. The Government of Canada, as part of Budget 2022, proposed to create the Tax-Free First Home Savings Account, or FHSA, a new registered account to help individuals save for the purchasing of their first home. The FHSA will allow Canadians to save up to $8,000 each year with a lifetime maximum contribution of $40,000. FHSA is expected to be implemented in both My Account and My Business Account in February 2023. FHSA in My Account will provide individuals via My Account and their representatives via Represent a Client the electronic channels to view FHSA account information. In My Business Account, the current TFSA BN program account with RZ Program Account Identifier will have its name changed to Savings Account Group and will include both TFSA and FHSA. The CRA is working to implement a digital identity validation solution as an alternative to the current CRA security code. Currently, taxpayers must enter their CRA security code to gain full access to their personal and business information online. The DIV solution will provide taxpayers with a secure method to validate their identity in real time, allowing full and immediate access to their personal and business information. Taxpayers will not need to wait the 5 to 10 business days for a security code to arrive in the mail. Note, we currently do not have an expected implementation date for this project as of yet. Non-resident tax account online portal. Preliminary work is being done to create a non-resident portal. This will be its own portal rather than being housed inside of My Business Account. It will tentatively be available to users around October 2024. Some options planned to be included in this portal are Make Remittances, Manage Account Address, Manage Language Preferences, Manage Correspondence Delivery Method and Notifications, Manage Authorized Representatives, File or View an NR4 Information Return, Manage Account Name, and Request to Close an Account. Did you know the CRA has 40,000 web pages with 220 million visits per year? 20% of the top 100 tasks across all of Government of Canada relate to CRA content. Pretty important that we ensure the service is optimized. The Web Optimization Strategy was launched in 2019 to improve the CRA's information services on Canada.ca and make it easier for people to quickly find answers to their tax, benefit, and credit-related questions online. Web Optimization has 3 objectives. Optimize content and features using web analytics, usability research, and call center drivers. Strengthen the agency's design operations model and enable the community to align with the new CRA user-centered design policy suite. And modernize the platform to enable a more interactive, dynamic web presence. There are 21 content optimization projects completed to date, and we are on track to deliver 2 more by December 2022. There are also 4 new features designed with usability in mind to help people navigate information on Canada.ca. This concludes the presentation. We want to thank you for participating.
Thank you, Stuart, for these updates from the Canada Revenue Agency. Now, on to the updates and tax changes that Revenu Québec has in store for us for 2022. To tell us more about them, we welcome Mr. Éric Godin, Business Architect for the Electronic Service Delivery Products Department at Revenu Québec, who will also tell us about the work carried out as part of the CSEV project. Éric, the floor is yours.
Hello, welcome to this presentation for Revenue Quebec. My name is Eric Godin. I am a business architect and a product owner. What we have in store for you today, here is an outline for the presentation. We have a quick introduction, and then we're going to go into detail for some new features in my account. These new features are for the three main my accounts. My account for individuals, for businesses, and for professional representatives. I'm going to go into detail into those features in the next few pages, and obviously the questions and comments are only for the live presentation, so I'm not going to ask myself some questions here today. So quick introduction. As with many businesses in the last few years, Revenue Quebec, we've been trying to improve all our electronic services so we can communicate better using, well, you guessed it, electronic services with our clients. We know it's not been easy for all businesses in the last few years, so like everyone else, we're trying to make some improvements. What we've done already in the last 2 years is we started to accept electronic signatures on a lot of forms. For example, we started with the MR69V, which is one of the main, which is a form that we still receive in the tens of thousands each year. And we've added some forms in the last 2 years. And just so you know, it's a progressive work, and we're going to add more forms as time goes by. I'm practicing my English today at the same time, so please bear with me. And the second point in the introductions is online communication and document exchange methods. That's what we're going to go into details in the next few pages. So a new feature, exchanging documents electronically. We already started in May of 2002 with my account for businesses. That's the first one we've done in May of 2002, and there are two main features that are available since May. The first one, it lets the client receive documents from Revenue Quebec. So someone from Revenue Quebec sends one or multiple documents to a client, and the client goes into my account for businesses and can can open the documents and save the documents on the hard drive, and I don't know what he'll do with it afterwards, but that's the first feature that we've already delivered in May. And the second one that's available since May is Revenue Quebec can request documents in my account for businesses. So the business can go into my account for businesses and send the requested documents to Revenue Quebec. In the next few weeks, we're going to add those features in my account for individuals and for professional representatives. And we're also going to add a third feature, which is send other documents. That's so that individuals, businesses, or professional representatives can send us documents without us without having had a request from us first. So, for example, it's documents that they send by mail today or fax that we've developed a feature so that they can send it to us electronically. So I'm going to go into detail for all of that in the next few pages. It won't be that long. But the first feature that I've talked about earlier, receiving documents. So Revenue Quebec can deposit documents in my account. So someone from Revenue Quebec needs to send a document. He can do it electronically. The client will receive an email in their personal email to inform them that they have received some new documents in my account. Then the client has to go into my account and he can download the attachment. So visually, what that means is if we look at this page, this is the email that is sent in the personal email. It's only in French because of the laws in Quebec regarding the language. But what it says is only go look into my account. You've received a new communication with documents, so you know that you have received documents from Revenue Quebec. And then when you go into my account, you need to go where your messages are, and you will see. All right, my apologies. We have these pages in English, so I don't know why they're in French in the presentation. But anyway, you have, if you look at the page, you can see that you've received a new communication in my account. And when you open it, you have a text that says you've received documents from which employee at Revenue Quebec and their phone number, so you know who actually sent you the documents. And you have the attachments, which are the documents that have been sent. And you can, like I said earlier, open them and you can save them on your hard drive or whatever. And if you look just above the documents that were sent, the attachments, there's a reference number, which is 3441. That is a unique number regarding this transaction. So if you call Revenue Quebec, it's very easy for us to talk about the same transaction because we have the same reference number. So it's a unique number regarding this transaction. So for receiving documents, it's not harder than that. It's pretty simple. The second feature, Revenue Quebec may ask a client to send documents in my account. So Revenue Quebec is still someone from Revenue Quebec that has to send a request. So someone from Revenue Quebec sends a request in my account. Just like the first feature, the client will receive an email informing them that they have a document request in my account. Then he has to log into my account and he can see all the document requests and send the requested documents. And then in a few seconds or minutes after he sent it, we receive the documents and we can actually do whatever we had to do with them, depending on who asked the documents and what they need it for. Again, I guess we only have the pages in French again. So this is an email that you will receive in your that the client will receive in the personal email that says that there's a request for document pending in my account for businesses. It's the same thing for all my accounts, everything that I'm showing you. So my accounts for individuals, businesses, or professional representative is going to be the same features. But this is just the email that you will receive. And again, if you go here, you see there's another communication which is called demande de document in French, which is for the request of documents. And if you open that communication, the message is the same as earlier with the name and the telephone number of the person that sent you the request. You still have a reference number that is unique to this request, but instead of having the documents that were sent to the clients, you have a link to the page where you can actually, where the client can actually answer and send us the requested documents. So if you click on that link, you get to this page, which has all the pending document request. You have the reference number in the first column. You have the requested documents in the second column. You even have a date, a limit date that you have to respect, because that's what the person from Revenu Quebec asked. He asked for the documents before that date. If you can still, the client can still answer and send us the documents even if the date is expired. That's okay, but you can see that we need the documents before that date. And at the bottom of this page, you see that there's another. There's a demande de document complété with a plus. That is the history of all the request documents that have been answered in the past. So the client loses nothing. He can see what he did in the past, what he exchanged in the past with Revenu Quebec. And if for some reason we cancel the request for documents, if you look in the last column, the second number, reference 1429, that is a cancelled. I'm sorry, I keep clicking on my mouse. That is a request that has been cancelled by Revenu Quebec. So you can actually, you don't lose anything. You see that you've received it, but it's been cancelled, so you know you don't have to answer it. When you actually click on the link to send us the requested documents, you get to this page. This feature is not very complicated. You see there's only 3 pages, and the first one is where you need to add the documents that were requested. The second page is just to verify the information, and the last page is a confirmation number that it's really been sent to Revenu Quebec, so it's not really complicated. As you can see in this page, the person has joined one PDF, Annex B. You can join more than one document for each document requested. So for Annex B, A, B, or C, you can join 2 or 3 documents if you want. But in this example, we only see 1. And that's pretty much it. Once you join all the documents, you click you click on next page, and then you get to verify the information, and then you click on send, and you get your confirmation number. So yeah, that's pretty much it. So that's the second feature. The third feature, the one that you see on this page, is sending other documents. So those are documents that we don't have any online services to send them. Typically they're sent by mail or fax or some other non-electronic method. So we're going to add this feature so that clients will be able to send us those documents electronically, and you can actually see real examples on your screen right now, like voluntary disclosure. It's a form LM15V. That is a real document that we're going to add to this feature. There are going to be more. Those are just examples, but just for your information to help you understand. And what it's going to look like is, first of all, to access this new feature, you're going to go here where you went earlier for the requested documents and the documents that were received from Revenu Quebec. And you see there's a link with the red arrow. It's all in French, but this link leads to this new feature where clients can send us documents without a request from Revenu Quebec, and it's going to look a bit like this. Again, it's in French. The subject is not the right text exactly, but it's just so you understand how it's going to work. So you're going to have to select from a list of subjects, like what kind of document do you want to send us, and then for each subject you're going to have a list of documents that you're able to select and send to us. And if you look at the example on this page, they are the documents selected. This is a group of 2 documents that are mandatory, And then you have another section where the client can send like other attachments if needed for those documents, but it's not mandatory to go on to the next page. But this is just so you get an idea of how it's going to work. But yeah, that's pretty much it. And like we're going to receive the documents a few seconds, a few minutes after they're sent, and then we're going to, depends on what's been sent, but it's going to be a lot quicker than mail. So that ends the recorded presentation. Thank you very much and take care.
Thank you very much, Eric, for your presentation. Once again, we remind you that our presenters will be available to answer your questions in the virtual booth area. The next presentation will be a demonstration of our Onvio Tax T1 product by our colleague Scott Drummond, Project Manager, Professional Software Canada, here at Thomson Reuters DT Tax and Accounting. Over to you, Scott.
In this video, you will see how to create and file a set of tax returns for a family. Let's get started by logging into Onvio. To create a tax project for a client, we use a project template. Let's open the T1 project template. You can configure the recurrence frequency and generation method for projects. This T1 project template has a due date of April 30th of each year. And new projects are created each year 4 months before the due date, or January the 1st. There are many options for automatically assigning staff to projects. Here we'll assign the staff member that is associated with the client of the project, and we'll save the changes. Before we can create the projects, we need to have the clients added to Onvio. In this case, we've already added the family head Julia Carter and the spouse Nicholas Carter. Let's take a look at Julia's information. In order for Julia to see her tax return once completed, we'll enable Client Center access for her. Julia will receive a registration email. Now we'll do the same for Nicholas. Since an email address hasn't been entered yet in the general information section, I'll add the email here on the fly. Onvio lets you set up various relationships between clients. Here we'll add the spousal relationship between Julia and Nicholas. Because Nicholas is already in Onvio, I can simply search for him. Julia and Nicholas have one child, Wayne. Let's add him now. We can now add the parent-child relationships. Onvio lets you add a new relationship to either one spouse or to both spouses at the same time. Relationships can be seen by clicking on the relationship icon for a client. You can see that Nicholas has a spouse and one child. Julia has the same thing. Wayne has 2 parents listed. Onvio lets you edit multiple clients at the same time. I'll add myself as the associate for all 3 of these clients. Now that we have the clients and project template set up, let's create a tax project for the family head, Julia. We'll select the T1 project template. Now we can open the tax project in Onvio Tax. We only have one tax project so far in this family. Let's create a tax project for the spouse, Nicholas. Now we'll create a tax project for their son, Wayne. All tax projects for the family have been created. Let's launch the project for Julia and start entering data. Some of the information has automatically been populated using the general client data we already entered into Onvio. Let's use the CRA's Autofill My Return service, or AFR, to add the data that the government has on file. This will save us from having to manually enter it. Once the data has been retrieved from the CRA, it will be displayed in Onvio on the right-hand side of the screen. Onvio hides empty rows to make it easier to review the AFR data. The AFR data is not part of the tax data of a project until you transfer it into the project. Now we'll switch to the data entry of Nicholas. We'll use the CRA's AFR service to retrieve his tax data. After reviewing the data, I'll transfer it into the project. Now we'll repeat the process for Wayne, their son. Wayne doesn't have any tax data, so we won't bother using the CRA's AFR service. Let's take a look at the Review tab and see what we have so far. Everything looks fine for Wayne. Let's take a look at Nicholas. Onvio is reporting that the e-file information has not been set up. Because this is a new Onvio firm, I haven't had a chance to do that yet. Let's do it now. Now that that's done, let's return to the Data Entry tab and enter some additional tax data. We can use the search feature to find out where to enter medical data for Nicholas. We have the option to include location information in the search results. This can be useful when the same type of data could be entered in multiple different locations. I'll use the row menu to add an additional row. Now let's switch to Wayne. We'll use the search feature again, this time for childcare expenses. Finally, we'll switch to Julia. To prevent accidentally deleting data, we have added a warning when you are about to delete multiple rows containing data. We'll again use the search to find out where to enter data for the Ontario Trillium benefit. Let's see how things look on the Review tab now. There are now no errors for any family member. Let's take a look at a few of the actual tax forms. It's time now to go to the File Return tab and file the tax returns. Onvio Tax lets you request e-signatures from clients for selected tax forms. Here we'll request it for the T183. One place to see the e-sign status is on the Project Properties page. Once the T183 has been e-signed by the client, the status will be automatically updated. The status now shows that the T183 has been e-signed by the client. You can also see the current e-signature status by clicking on the e-signature button. It is now time to e-file Julia's tax return. It's been accepted by the CRA. We'll repeat the process for Nicholas. His return has also been accepted. Wayne, their son, has no income, so we won't file a return for him. Let's save a copy of Julia's return to Onvio Documents. You can easily open Onvio Documents for the family member that you are currently working on by clicking the Documents icon at the top of the page. Let's take a look at the office copy we just sent to Onvio Documents. To make navigation easy, you can use either thumbnails of the pages or browse through a table of contents of the pages. Let's return to Onvio Tax. You can also access the client dashboard of the family member that you are currently working on by clicking the icon in the header. This can be useful if you need to send an email to the client or want to consult previous billing information. Let's return to the Projects tab. You can see that Onvio Tax has created the projects for the spouse and one child. You can customize the Projects tab by adding and removing columns. I like to include the project number and tax year columns. Columns can be rearranged and sorted in ascending or descending order. A slide-out filter is available on the left-hand side of the screen. It provides numerous ways to filter your project data. For more information on Onvio Tax, please visit the Onvio booth.
Thank you, Scott, for this demonstration of Onvio. We now welcome our colleague Carl Bujikanyan, Senior Human Factor Design Engineer at Thomson Reuters DT Tax and Accounting, who will present us with a recap of the comments and suggestions shared by our Onvio early adopters. In other words, some feedback from our pioneer Onvio users who were working in Onvio Tax for the first time in 2022. Over to you, Carl.
Welcome to the Synergy 2022 session entitled Early Adopters, the 2022 Recap. Our pioneer users working on Onvio Tax for the first time share their feedback with us. So I'm Carl Bujikanyan, and I'm the UX User Experience Design and Research Lead here at TR Tax and Accounting Canada. So let's get started. So on the agenda, we're going to take a look at the onboarding to Onvio Tax overall process. So principally how it unfolded during the tax season last year. We'll take a look at some of the key topics that we covered during our onboarding sessions with our users to help them get started and be productive in Onvio Tax. Then we'll take a look at, what delighted our early adopter users when it came to using Onvio Tax on their own, when it came to filing and preparing. And afterwards, we'll take a look at some of the challenges, actually the biggest challenges that our users encountered and the biggest requests that they asked from us. And then we'll take a look at this upcoming tax season and more importantly, what sort of updates and enhancements we brought to the product based on the feedback that we received. So, onboarding to Onvio Tax last tax season. The onboarding approach that we use is based on, doing some small steps and obtaining some feedback from you guys, ensuring that like things are being sort of understood and you feel productive. And then we move on to sort of another kind of another kind of a task that you might want to do as a tax preparer, and then still again ensure that like you have the knowledge that you need to move forward by yourself. So it's not a linear approach. It's not the kind of thing where like you just get sort of like a 1 hour sort of like session with us and then you're completely on your own. As the illustration here shows, it's more of a circular approach. It's we do have our initial setup meeting. We talk about sort of how you migrate DTMax files to the cloud, so to Onvio Tax. But also, every time you try something by yourself, you are welcome to circle back with us via email. And then if we need it, we'll meet one more time. And then you give us your feedback, or if you're stuck with something, we'll help you to be, unstuck, so to speak. So really, that's what the approach here is, and that's what we're trying to demonstrate here in this slide. And what's important here is that as per our last season's users, it wasn't really just about trying the product. A lot of users actually tried the product and then they filed using the product because they felt confident using Onvio Tax. So we'll go a bit through a bit more details about that in the further slides. So in terms of one of the biggest pieces as you onboard, it's migration of your files, right? So the way that unfolded is last year, and actually it's going to be quite similar this year as well, is firstly you would need to provide us a client list export from your DTMax software. That's sent to us in a secure fashion. We migrate that to the cloud, meaning all that data lives in Onvio once we're done with it, and then we notify you. And then by data, we mean not just the client data, we mean also, of course, the client data and, of course, the tax data related to that client. So in this case, it will be the prior year data of that client, of all the clients that you've selected to send us. And then once we notify you, you go online, you log into Onvio, and then you'll see that all the 2020 tax data is living in Onvio at that moment. So they get listed in the projects grid in Onvio, which some of you may be familiar with. From that point onwards, it's really all about just selecting the projects that you're ready to work with, and then just doing the carry forward officially in Onvio Tax at that moment. And then what that gives you is the ability to work in a similar fashion as in DTMax, where once you're in the tax file, well, in Onvio it's called the tax project, you would be able to, as you do your data entry for the 2021 tax year, you would be able to see the 2020 tax year for reference on the right side of the screen. Um, well, that was last year. This upcoming tax season, it would be 2022 and 2021, of course. So, and that would be actually the same approach for users who happen to be U-file users. So we talked about doing this for DTMax users, but should you be a U-file user or perhaps some of your clients live in a U-file database, we would approach this in the same way. So what are some of the kind of other topics that we talk about? These are straightforward topics, but sometimes people do need some guidance, so we provide it. We talk about setting up a family. We talk about setting up your T1 settings. So all the areas here that you see on the screen that are highlighted in red, those are all topics that we go through. Similarly, in the data entry, we talk about the different ways that you capture data, and then we talk about the differences between Onvio and DTMax when it comes to the data entry. So once more, like the red areas there are showing you the different ways that you can capture data, and then there's the sort of like the interview setup fashion, which is for those who prefer sort of selecting and then navigating and selecting the things that they need. There's the keyword search area there at the top, which is the open search, free search, with the search results that come in, and then you choose what you need to move forward with. And then there's the download import menu where like you download import data from the government. Now in the body of the data entry screen, we see two blue sort of frames. That's just a quick way where for us to show that the product is quite similar to DTMax from the perspective of the data entry. Everything is captured on one page. It's still an engine similar to the keyword engine that's part of DTMax. In the difference in Onvio being that we're not limited to keywords written specifically in a particular fashion. When it comes to showing things, we show things in a plain language fashion as much as possible, and it's similar as you type in into the search bar. You don't need to type in the exact sequence of characters. Similarly, just general interface updates. It's a cloud-based product. It benefits from a lot of the cloud-based sort of like things that we're all used to. So when you, for example, need to search for an NAICS, you don't need to again navigate through a lot of menus. It's really just about just typing the word that you think that NAICS matches to, or if you happen to remember some of the digits, it will just filter to the ones that you probably need to select from. And then we talk about the file return tab, and then that's where you go ahead and then use a lot of the electronic services. So sending e-signature request, it's covered here. Sending or generating those PDFs that go directly into the client's sort of client center folder, that's talked about here. And then lastly, just on the table of contents side here on the left, you can see that there's a confirmation and backup copies. That's where once you file something, we keep a track of the things that you file with the government for easy access and reference in the future. Every time you file and refile, they're all staying there sort of in a historical fashion. Okay, so I think we're ready to talk about some of the experiences that we got feedback on from our clients from last season. So let's start with the things that delighted our users. Some quotes here. Be able to work online. We want to get rid of our servers, so we get a lot of feedback like that. That's only natural for folks who are willing or wanting to use Onvio Tax. It's one of the prime reasons why they want to go ahead with it. Before filing, I tried and saw that the returns in Onvio and DTMax matched. So that is also the kind of feedback that we received for folks who made it all the way with the product until the end, and they filed using Onvio Tax. The first couple of returns that they did is they double checked that like they're getting the same amounts in terms of balance, for example, between the two products. Once they saw that like Onvio is doing the same types of calculations, that gave them the confidence to move forward with the product. I can work from multiple computers and locations. That's another kind of feedback that we received often, and that's again expected. It's the kind of benefits of working in the cloud, which basically means no software installation. You can just, whenever you have a secure computer, you just go online and then get your work done. And then lastly, the last quote that we have here, the navigation menu on the left. So the table of contents that we saw, something that is again expected out of a modern software that lives on the cloud. Envio gets that. So the data entry screen is you're following the DT Max philosophy of everything on one page, but benefits from a table of contents on the left side. And as we mentioned, it's still familiar territory for our users who come from a DT Max background. Things are in that keyword sort of system. Things are not form based, so it keeps you in the same productive sort of work method that you're used to already. Some of the more sort of advanced things that our users noticed and they appreciated. So realignment options are options that come in handy when you're downloading data from the government, and especially for Quebec use cases when what you download from one government doesn't match the other government's sort of slip. It's the same entity, let's say employer, but it just has different names. This realignment sort of tool that we have in Envio now allows you to just realign before you merge your data. That way you don't get duplicate data, and then your tax return, you get to fix it before you even sort of like make some kind of error. For other jurisdictions, non-Quebec, this can still come in handy. Sometimes we get slips that are divided into segments. You don't get all the data from one slip in one shot when you download. This helps you, as you download, again, align with the right data entry group before you merge your data. And then just in terms of, let's say you've done a bit of manual data entry and then you've downloaded the slip afterwards because you heard that there's an update. If things aren't named the same way, it may not match when you do the download. So before you import, and again, you might end up with a duplicate data entry section, this realignment tool can come in handy. Let's get into the challenges and requests. We got a good amount of users who told us that like either we reached out to them a bit too late or they decided to register to an onboarding session too close to the tax season. So we're gonna try to address it for this season. I'll get into the details a bit later. Other sort of challenges or requests just related to speed. So we have a code here that says not terrible, but of course not as fast as desktop. It's a cloud-based product that's doing a lot of heavy calculations. We're always trying to make it faster and more efficient. We got some good news that we're going to be able to share in a few more slides later. But that was one of the things that did come up during our feedback sessions with our users. In terms of features, some features are still missing in Envio currently. So for example, historical data, even though we migrated, it stays in the data entry but does not get reflected into the tax return. That came up during our conversations. We're going to try to address it for this upcoming season. And then in terms of other sort of features that are missing at the moment, so the billing feature done directly to the through the tax software, that is not available at the moment in Envio Tax. That came up. Although whenever we got those kinds of feedback with our users, we try to steer them towards the billing feature that exists in Envio Center directly, which can do a lot of the heavy lifting. Lastly, just general automation and refinement requests came up. We have users that say, I do the same thing in DT Max, but there's less clicks. So that comes up, and then those are always things that we're trying to reduce the clicks and reduce the steps. We've done some updates related to that. I'll get into that shortly. And then just better integration. People expect for the product to be better integrated with Envio Center and Envio Documents at the moment. So Envio Tax not fully integrated with those two components yet, but again, we got some good news I'll be sharing with you shortly. So looking ahead to this upcoming tax season, the first thing that that I'd like to say is, while for the 2022 tax year, Envio Tax, the planner version is already available. So if you happen to be one of the users that used the product last year, you can already log in and then start using it for this year as well. You can do 2022 returns. They'll be in planner mode, of course. You'll see some updates compared to what you perhaps saw during last spring, and there's other ones coming up, and I'll get into that shortly. One of the main things that we're going to be addressing for this upcoming tax season are the calculations. They'll be done more quickly. So the tax data will be calculated more efficiently. So it's no longer whenever you click on another tab, let's say you're navigating from data entry to the review or the file return tab, we're no longer going to kind of like recalculate things from scratch. We're going to be more efficient and calculate only the things that have changed. That's going to make the product much more smoother and much more faster. The next thing that we're going to start introducing are the missing features. The first one that we're going to introduce is the historical summary, which could be also called the 5-year summary in a tax return. That's going to be one of the first sort of features that are missing right now that we're going to start adding. Lastly, some of those more sort of like refinements that people expect from the product in terms of like reducing amount of clicks to get a task done. Those are already in progress, and I'll be able to actually show you a few of those in the upcoming slides. So the first thing I'd like to show is just how we now have advanced integration between Envio Tax and Envio Documents. So let me grab an Envio Tax project here and then bring it in. And then let's say that for this tax preparer here, Louis Sabourin, we want to, do some filing tasks or some e-signature tasks or just sharing a PDF with them, for example, right? So at this point in the game, during the last season, it was very much about opening another tab and then going to Envio Documents and then looking for Louis Sabourin and then checking what their status is in terms of like, do we have their email or have they even been registered to Client Center, etc. Or maybe even check if you've actually already sent them a particular PDF kind of thing, So going forward, there's advanced integration. You just click on the top button here, and that automatically opens Louis in Envio Documents, and we can quickly navigate to their client folder and see what we have already shared with this user, for example. Similarly, if we want to check if Louis, in this case, they're very likely is a user who has, has access to Client Center. We can see that things are shared with them with the shared icon, but otherwise we could have quickly clicked this button here, and that would have quickly taken us to the client's profile, where we get to double check if we have actually already sent the request to join Client Center via these controls here that I'm showing you right now. So yes. So let me go back to my presentation. Next thing that I would like to show you is the live e-signature update feature that we're actually currently adding to Envio Tax. And then in this case, let's go back to our Louis Sabourin taxpayer, and then let me navigate to their filing tab in Envio Tax. Previously, the way this was done is during the last season, you would have had to navigate to e-signature here, the button, and from that point onwards, we can see here send request now, the button. We would click that button and it would send the e-signature request to the taxpayer. Basically, what happens at that point is the taxpayer signs, And they could do it at that moment, they could do it overnight. The next morning when you come in, at your office, and you or later in the evening when you take a look at your email, and then it says that Louis has signed the T183 signature, you actually need to go back into Onvio. Well, during the last season, you had to go back into Onvio, navigate back to the file return tab, click on the e-signature button one more time for it to actually take, so to speak, the signature that the taxpayer performed. So that's both in the actual tax application, but also in the documents folder where you actually get you get the signed copy of the PDF. And that's all saying even though you got the email. Now, going forward, what we've done is, of course, we had to streamline this. We got a lot of feedback about it. It was already on our radar. So this coming season, things will be much more smoother, much less clicks, much less things to remember. Basically, as you can see in my image sequence here, as soon as you get the email in, let's say, your mobile phone or desktop saying this particular person signed the T183, for example, then like right away you can log into Onvio, and then you don't need to click on any special tab. You don't need to navigate to the file return tab. The project properties will already be telling you what's signed, what's not signed. So we can see here the Sandy Coleman person, the dependent. We can see that like we have not submitted the e-file, but they have signed. Similarly, and that would actually unblock the T180, the T1, for you to be able to move ahead and then submit the filings. And then similarly, the documents in Onvio Documents, the signed copy will live in Onvio Documents again a moment or two right after you receive the email. There's no need to go to that e-signature button, click it to get some kind of update. Things will be as expected, more smooth going forward. Well, I think that's about it for this presentation. I hope you enjoyed it. I hope this encourages you to sign up for an onboarding session with us to get started with Onvio Tax. Please come and find us at the booth. Some other Onvio presentations are also available for you to watch. We recommend that you watch all of them. To let us know if you're interested or just if you have some feedback for us. Please come to the booth, or my email is carl.bujikanin@tr.com. And happy Synergy, and looking forward to talk to you. Cheers.
Thank you, Carl, for this recap of our Onvio early adopters feedback for 2022. Ladies and gentlemen, we will now take a lunch break. Don't forget that our workshops will begin at 2:30. In the meantime, we invite you to check out the additional video presentations in the workshop area. At 4:30, we invite you to join Eric Neveu in the General Sessions section for the closing statement and the draws. Thank you, and enjoy your lunch, everybody.